All right, guys. So today I have a great guest joining me. I say that all the time, but I've got a fantastic guest joining me, Marty Smith. He is going to help break down in as much detail as you could possibly want how infinite banking works and how you're going to be able to utilize it in your life, whether you're financing the things of your daily life or you're prepping yourself for a pension style retirement, because you and I both know when that time comes, Social Security most likely won't be there. So I hope you guys enjoy. We're going to hop right into it, and Marty is going to crush this. Buckle up because it's a long one, but you're going to get a lot from it. Make sure you're checking out the visuals over on YouTube or on Spotify, and enjoy. Let's get into it. All righty, Marty. Welcome to the channel, man. I'm excited to have you. We were just chit-chatting before, and I've seen the information that you're going to share today with my viewers and listeners, and I'm excited for them to see it for the first time because you and I both know, you probably more so than me, how powerful of a concept this is and how great the concept works when paired with the right product, which is properly structured whole life insurance. So, quick little intro for Marty. He's the regional vice president of Security Mutual Life, SML, and I'm going to call him the number one supporter of IBC. He'll call himself something else here different in just a second. But this guy, nobody is more proud to preach this concept from the mountaintops than this man right here. And he's in the, what do they call it? The concrete jungle out there in New York.
Oh yeah, I'm down in the jungle here down by Wall Street. So it's
He's in the thick of it with big money players and everything like that. And Marty is teaching and preaching this concept to whoever will listen. He's got some incredible stories from, how he got to where he's at, learning about this and everything. But today, I'm excited for him to share really some of these nice numbered details about how this actually works and the way that you can use it to finance your everyday life. So, Marty, I'm gonna pass it over to you, man, and let you take this thing away.
well, thanks, Shawn. I'm really excited to be on your podcast with you there. Uh, as Shawn said, I am the regional vice president of Security Mutual. I call myself the champion of infinite banking at Security Mutual. I am the of becoming your own banker. I am the guru who puts this all together, who promotes it all the time. I'm at the airport. I'm talking to people who are working in the Hudson News there. When I'm buying my water, I give them my card. I tell them I'll send them a book. It's Nelson Nash's book. It's just something that's very natural. That it turns out that Nelson Nash was looking for his uh, for apostles, for his disciples. And guess what? It turns out that I am still one of his many messengers who is out in the world and proud to be there and just loves to talk about this concept because this is the most important concept, the most important way to think about money and how you live your life, how you spend your money.
Hmm.
Again, ultimately, what Nelson would say is that this is a personal wealth building system. If it's anything, it's a personal wealth building system that's going to change the way you think about money and the way you use it. And that's what's so exciting about this whole process here. And I'm just so pleased to be here and be able to share all this stuff. Now I'm going to be doing a lot of detail here. So
Yeah, buckle up.
now I love this. Now I'm going to do it,
Yep.
and I'm hoping the audience will follow along with us here. So
Hey, that's
it's
why we record it so they can rewind it and
very
watch
good.
it, hear it again. So
Sure.
we are good.
Sounds great. Sounds great. So why don't I share my screen? All right, good. So let me tell you what happened. It was literally what happened was I went to a conference that's called Cal College Circle of Wealth. And when I was down at Circle of Wealth, there were all these people who love uh, selling. What should I say? This whole life insurance. So that was my purpose because that's what I do. I help bring people to the company to sell Security Mutual Life's products there. But when I was there, the key thing was somebody said, "Hey, this guy Nelson Nash, he's down here and he'd like to meet somebody from Security Mutual." So
Hmm.
obviously, I said, "Hey, I'm the only one here from Security Mutual right now. Please introduce me." So I went and I was introduced to Nelson. He spoke to me in his wonderful Georgia drawl there, and we had a great time. And he actually sold me the book. And I said,
Man.
wow, okay. Here's my son-in-law, David Stearns. Please give him $20 and you can have this book. I said, really? Okay, great. So it was the best $20 I ever spent in my life because what happened that night is I went back to the room, I read that book, and it was like, oh Lord, please tell me. Please tell me I have finally found what I've been looking for my whole life financially. It just was a wonderful, wonderful thing. I read that book again. I read it again on the plane going home back to New York City where I live. And from that point on, it was just full steam ahead
Mm.
in terms of changing my life and how I would use that, how I would use the information in that book. But this is what I saw visually. And I call this my aha moment that proved to me instantly that using the infinite banking concept, becoming your own banker, was exactly so different from what I was thinking before. It changed the way I viewed the world. So, what do we have here is what I call the zero line. And the zero line is, hey, when you start off in life, guess what? What do you have? Well, you don't really have much savings, whatever. You're at zero, but you do have a job. And once you have a job, Shawn, what are people willing to do once you have a job?
Hopefully pay you.
They'll pay you, but guess what? They'll also want you to they'll also lend you money. So let's say I've got to drive to go to work, so I'll need a car. So I'll go down to the dealership, whatever. I'll get a loan, and that's the red lines below the zero line. So I take a loan, and guess what? I drop right down because now I owe money.
Hmm.
Then I'm going to have to repay that loan on their schedule, and I step it up there and pay back the loan principal and the loan interest. And Shawn, what happens when you finish paying off the loan? Where do you end up?
Right back where you started at zero.
You end up in zero. And if you haven't accumulated any money yet, what happens then? Well, you got to take another loan,
Yep.
and then you got to repay that loan. And where do you end up again?
Right back at zero.
Right at back at zero. And so this was the way I was living for a long time. But guess what? Sometimes, say like when I grew up, my parents, they didn't have credit cards because guess what? I'm older than I appear. Anyway, they never had any credit. So whenever we wanted to buy something, we'd always have to save for it. So saving is a good habit to have. But when you save, you kind of stair step it up until you get to that high point where you've accumulated enough money to buy that car. Let's say you were going to buy. But it's the best day because now you have the money, but it soon becomes the worst day because Shawn, what happens when you buy that car? Where does that money go?
Going right back down to zero. It goes
You
to
go right back down to zero. And then if you're a real saver, guess what you have to do? Well, you start stair stepping it back up because guess what? You're going to need other stuff and you need to save for it. And then you get back to that point again, the best day and the worst day. Where do you end up? You end up back at zero. This is the way most Americans live. It's heartbreaking and it's terrible because the question then begs begs you to ask, is there a better way than what I'm seeing right here? Than saving for things and buying them or or having to get loans to buy things? And guess what? There is a better way. And that way is using, oh, guess what? Life insurance here. So I saw this thing. And how does life insurance really work? Well, again, it's kind of like saving because you kind of stair step it there. But ultimately, when you see that rising green line that goes up across the page, that's just the plot of the cash values in your policy to age 100 or to age 121. It looks like this rising accumulation line. So now the question is, well, hey, listen, if I put my money into dividend paying whole life insurance and I need to buy a car, what's that going to look like? Oh, well, you're going to have to take a policy loan. And so if you take a policy loan, what's going to happen? Oh, wow. Well, it's going to look like just like taking a loan down below because you're going to get money, right, from the life insurance company. And then guess what? You're going to pay it back.
hmm
But when you pay back the policy loan to the life insurance company, Shawn, what's the big difference there? Do you end up at zero?
Nope. My money
No.
continued to
Oh,
grow.
my Lord. When I saw this, you don't end up at zero. You end up somewhere higher, higher up on that rising accumulation line.
Mm.
And when I saw that, I realized, hey, listen, even if I have a lot of money and I take a loan, where do I end up after repaying that loan?
Zero.
I end up at zero. I do have the car that I bought, but maybe it's a 5 or 6 year old car. But if I use life insurance and I buy that car, not only do I have that 5 year old car sitting in my driveway, or in New York City, we would say on the street, but, but guess what? I have I have all the money that I paid for in terms of the policy loan principal and the amount of the policy loan interest. Where does that money all go back to? It goes back into my policy ultimately. Wow. That's something else. And that something else is what I want to prove to you in using the next slides by actually using real numbers here. So what I have over here is, I work in New York City. There's a lot of people who make a lot of money. They have a lot of businesses. So for this particular business owner, he makes a lot of money and he was going to put in $132,000 a year for 10 years. I mean, I use this as a 10-pay policy just so you could see this because premiums will stop. Now, the wonderful thing about life insurance you should understand is normally if I lop off the zero at the end of 132,000, I put in 13,000, I can lop off just about all the other numbers that you see in the illustration there. So the death benefit would be like 400,000 as opposed to 4 million. So just understand that this is just all in relative perspective here. This is a business owner. This is what he did. This is why he put in money. So he's going to put in 132,000 for 10 years. What is the total surrender value in the 10th year, Shawn? Can you see that on the screen?
Yep, total surrender value on the guaranteed side is 1.18 million.
That's right. And then with dividends on the non-guaranteed side, it's 1.263, right? So the interesting thing about this is when I ran this illustration 10 years ago, guess what? Security Mutual Life has maintained its dividend for all those years. So this is exactly what shows up for the client, right? Security Mutual has been around 140 years. This year, it's going to be our 140th anniversary. We've paid dividends for the last 134 consecutive years. So we're kind of proud about that. We're the biggest small company you ever want to deal with. We're domiciled in Binghamton, New York, which is on the southern tier of New York, for those of you who like their geography. So here we go. So once we put in this money here, guess what? What I want to do now is I'm going to take a loan. So I want to graphically show how this would work. So I'm going to plot the 10th year, the 11th, 12th, 13th, 14th, 15th, and 16th year total surrender values from the non-guaranteed column there. So it's going to be 1.2, 1.3, 1.38, 1.4, 1.5, 1.58, 1.6. And you'll notice, oh, I've used some sophisticated graphic tools.
Yeah, this is impressive.
I don't want to break the bank here. So I bought, graph paper and a ruler and guess what? Some colored pens so I could show you what this looks like. So this number, and normally there would be more of a little curving slope, but I did this just so we could see from years 10 through year 16. And that's the way I plotted this. And this is something important to realize. This is just it's going to look like this throughout these next slides that I'm going to show. So what I'm going to do is, hey, my business owner, he needs to buy a $500,000 piece of equipment. Well, he could loan it and pay interest to somebody else. And what does he have at the end of the 5 years once he pays that off, Shawn?
What we're looking at here, he's got.
If he were to take a loan from somebody other than using a policy loan, what is he going to end up with after 5 years after paying the policy loan after he pays the loan principal and loan interest? Nothing. He's just going to have the equipment, which is good, right?
Yep.
He's buying the equipment. Why? To make more money. Mm-hmm. When he takes a loan from somebody else, it's an amortizing loan. Does he have control over how much he pays and when he pays it?
Sure does.
No. Oh, that's when he has a policy loan. But when he takes a normal loan,
not when he takes
he doesn't have control at all. So that's why that's one of the key things about becoming your own banker. You want to be in control. That's the whole point about becoming your own banker. You're in control of how much you pay back, when you pay it back, or if you pay it back at all, right? So he's going to take the loan. And so then what happens here is, notice that the 10th year cash value was 1.263 million. So if he took a $500,000 loan, right, You can literally subtract it from that. He's going to have what remains is 763,000. And so what I've done is I've graphed those different points from what it would look like by taking a loan and not repaying it, right? So the red line down is that's the 500,000. So that's 763 roughly. But let me go back. And Shawn, what's the net cash value at the end of the 11th year?
795.
So wait a second. So I took 500,000 out. I'm really down to 763. And now all of a sudden, they're still paying me dividends?
Yep, looks like
What
it.
the heck? Oh, you know what that's called? It's called non-direct recognition. Even though a policy loan is outstanding, the company is still paying all the dividends that it would have as if no loan was taken. Wow. So there, notice the blue point at year 11, it shows that, guess what happens? Even though the loan is outstanding, the cash value is still growing. Wow, it's amazing. And so then if you go back to the line, you'll notice that the numbers are going to be much lower. It's 795, 828, 863, 899, 937. So that's what I've graphed over here in this. So you know it's going to go parallel, but an increasing parallel line, just like we did before. So here, the situation is, if you were to, why does the company show this? Well, if you were to surrender the policy, you would receive the cash value that remained in the policy. But if you repaid the loan, that's the dotted green line going across, which is similar to this line. It would restore the contract. That's something everybody should understand. When you repay a policy loan, what you're literally doing is restoring the contract to what it would have been as long as the dividend scale was the same, right?
Yep.
So that's the way that that works. So now let's take a look at this. Over here, between years 11 and 15, what I'm going to do is, oh, wait a second. Shawn, if I had a regular loan from a bank or from the car dealership or from the manufacturer where I bought this equipment, notice what was my loan payment in year 11?
Yeah, year 11, it was nothing.
Zero. Now, could I actually do that with somebody else on a commercial loan? Never.
You're probably not, yeah.
So why? So think about this. I could have started repaying the loan, but I didn't, and I never showed repaying the loan after I took it, just to make this point. The whole point about this is who's in control when you take a policy loan?
I am.
You are. It's not the life insurance company. You are. You are in control. This is the reason why you want to do this. So again, the interest rate I think was 5.3% over here. If you don't repay the loan within the first 12 months, the loan is going to accrue, right, to the policy loan. So now you have a $526,000 loan, right? So what I'm going to do is I'm going to repay the loan in as close as I can equally for the next 4 years in order for in year 15 so that the total loan would go back to zero, right? So Shawn, do I have to pay it back in equal segments like this, the way I've shown here on the illustration?
Sure don't.
You don't. I could have paid it up. I could have paid it up within 12 months. I could have paid it up in within 2 years or 3 years or 4 years. It doesn't matter because the whole point about this is who is in control. And darn, you want to be in control. This is why you want to become your own banker. This is why people want to do it. This is why everybody who's listening to this needs to understand you are in control when you're doing this kind of work here. So what I'm going to do is I'm going to pay 142,000 for the next 4 years, a little bit less in year 15, because guess what, Shawn? I'm not that precise of a guy. I'll be close, but I don't need to. I don't need to make sure everything looks exactly the same. So I'm going to put it as, so it's a 142, right? And then notice over here, just in terms of looking at the numbers, once I repay the loan, what is my net cash surrender value?
At year 15,
15, yeah,
1.584 million.
1.584. And what would it look like on the illustration if no loan was ever taken?
Looks like it would be 1.584
Oh,
million.
how do you like that? It's the same damn number.
Yes, it is.
That's the way it is. The point is, I've restored the contract to what it would be. The death benefit is 5.025 million. And over here, It's 5.025 million. That's the way. This is simple arithmetic. It's simple concepts here for everybody to understand. All right. So now what am I going to do? There we are. So now I'm going to graph that 142,000 that I paid in year 12, that I paid in year 13, that I paid in year 14, and what I paid in year 15. So if you're a math whiz, and I'm sure you are, Shawn, whatever, 4 times 142,000 is equal to,
I'm going to assume it's 568, the
well,
total.
you don't have to assume at all. You're darn right, it's 568. That's it. I'm never going to ask you a tough question here that I don't give you the answer to right on the screen.
I
So
appreciate that. All right, you guys, quick interruption to the video. First things first, I wanted to make sure that you are subscribed to the channel. I greatly appreciate you watching my videos. So do me a favor, if you're not already subscribed, go ahead and go smash that button and click that little bell just to make sure that you're getting alerted every time I put out new content. Number two is I got a lot of great content on my website. Go ahead and go check this out. There's all sorts of free resources on there that you could plug into and a bunch of other great information on the website. So be sure to head over to legacylifeandretirement.com and go check that out. All right, back to the video.
so it's 568,000. So what was the loan principal?
5.3.
500. No,
Oh, loan principal, got
the
you.
original loan was 500,000, right? So the 68,000 is what?
Interest paid.
Oh, that's the interest, right? So now notice something peculiar about this. So each year I pay 142,000, but it doesn't go up to that blue line because that blue line is what the actual cash value is according to the illustration, right? I pay 142,000 and my net cash surrender value in year 12 is what, Shawn?
Year 12 is 978.
978. The next year it's 1.17, 1.32. And then ultimately it goes back to what it was because I finished repaying the loan. But there's a gap. I've only given the life insurance company, I paid them 568,000, and there's a gap. It's not reaching all the way up. In fact, there's a gap of $220,000 between the amount of loan principal and the amount of loan interest I've repaid. And there's an additional $220,000 that's inside, amazingly, inside where? Inside my policy. What is that 220,000?
That's the uninterrupted growth your policy was having while utilizing it.
Did I talk to you beforehand about this? You're not even using the language that I'm going to use. It's the uninterrupted compounding that takes place because, Shawn, when you take a policy loan, whose money do you use?
I use the insurance company's money.
You're using the insurance company. You're using OPM, other people's money. So not only think about this. What does Nelson always talk about? He used to talk about, why do you want to do this? Well, you want to recapture the loan principal and the loan interest that you're paying to the life insurance company. So once you recapture that, there's a third element. That's the growth in the contract. That's always going to be there. So take a look at this picture. What happens in year 12? There's a gap there. There's a gap in each year. So if I were to do this more precisely like this, I put in 142,000, but guess what? There's an additional 40,000 that shows up in the contract. Wow. In year 13, there's a $50,000 gap. In year 14, there's a $60,000 gap. In year 15, there's a $70,000 gap. And the funny thing about this, Shawn, is this is just simple arithmetic because if you add up 40,000 plus 50,000 plus 60,000 plus 70,000, what does that add up to?
That's going to equal 220.
It's equals 220.
Yep.
It shows up. It's just amazing to me.
Yeah.
Now, what everybody should understand about this is the actual way. This is based on the numbers that we're picking off the illustration right here. You can go back through this, look at this, add the numbers up, put the 140 in, adding it to the previous number, and you'll see where these numbers come from. Well, there's no trickery in this, right? This is just plain, simple arithmetic that works here. But the key thing I want you to understand is this. When you repay your policy loan principal, that policy loan principal is recollateralized into your contract, right? Automatically. Once you pay it, it's recollateralized into your contract. The policy loan interest of 68,000. Who's receiving that 68,000 loan interest?
The insurance company.
The life insurance company. That's how the life insurance company makes money, right? That's why we continue, that's why we paid dividends for 134 years, because we loan money out,
Mm-hmm.
right? We either make money from investments there or from policy loans. Policy loans become a asset to the company,
Just
right?
like it is to a bank. Yep.
Just like it is to the bank. The life insurance companies are like big banks, but guess what? they they don't do any
They got all
fractional
the money.
reserve
Yeah, that's
lending.
all the money.
They lend out your money, right? Right. It's like, but not really lend out your money because what happens is you're taking money from the life insurance company's general account. Your money is where? Oh, it stays inside your policy. The cash value stays inside the policy, compounding uninterrupted, even while loans are taken. So that's 68,000. That's not really going into your policy. So, but if it's not going into your policy, that would mean that instead of 220,000 of growth, what literally took place in this particular specific example that I gave you is that 68,000 was really part of the growth in the contract. So instead of being 220,000, it's really 288,000 that your contract grew over those 5 years in time. Wow. That's what it grew to. Pretty amazing. That's how it increased. So when I saw the original aha moment, I knew how it worked. And now all I wanted for everybody who I ever deal with to understand is it's simple arithmetic of how the policy loan interest, and growth in the contract. This is what it would look like throughout there if you took a policy loan. This is why it's so powerful, because now all the if if you use other people's money, right? And that's what you're using when you take a policy loan. All this growth is going to show up where? It's going to show up back in your pocket in your policy. This is why you want to become your banker. So what's going to happen in year 16? Who knows? Maybe I got to pay for my children who are college age. I can use this to pay for college. I can use this for more business. I can use this for buying cars, for any major capital purchase I want to make, for making investments there, for private lending, for being in real estate. This is how this all works here. But again, what you need to do is you need to capitalize on this. You need to capitalize your policy. In fact, Shawn, I would say that dividend paying cash value whole life insurance is in my opinion, it's the best money storage system that's ever been created,
I would second that opinion.
right? You need a lifelong cash flow, money management, savings protection, acquisition financing, and wealth creation system. That's what you have right here, right? That's how this works.
Sometimes, Marty, I feel a little biased because we're in the industry and we believe so strongly in this product. But I think when you like lay things out and just if you were to, I used to say this on my podcast all the time and on my channel, if you covered the name of the products and you show
Right,
all the benefits that they included, there's not one person out there that wouldn't pick whole life and everything it provides you with versus every other thing that maybe checks one, two boxes here or there. But then
right.
when you remove the name tag and they see that it's whole life, they're just like, that guy Dave Ramsey told me that this is the devil. I'm not doing whole life. So it's crazy how it works. And again, I'm not gonna
Right.
I think I am
Yes,
biased, but I'm also a realist. And I know Shawn, who doesn't know anything about life insurance, would have picked the one with all the check boxes.
exactly. Exactly. As we used to say when I would go down south, would it bother you to find out that you've been lied to, misled, and misguided? Yeah, bother me.
A little bit, yeah.
Yeah, it bother me. But that's the way it is. The banks have no responsibility to tell you how they make money, and they don't, right? They don't. That's why what Nelson has done, what we try to do around the country, what we try to educate people on is guess what? There is a better way for you to become your own banker. and for you to have a personal wealth building system that's going to work for you and your family. Because ultimately, what's the most important? What's the most important business you have? Well, it's your family. Your family is your business. Everybody needs to understand that and start treating it that way. And if you use dividend paying whole life insurance, guess what? You're going to understand how this really works, how money really works. You're going to be vibrating on a different level, understanding this. So that would be what I would want to talk about. And when it comes to that, the next thing I would love to do, Shawn, if we have some time,
Sure do.
is to talk about one of the writers that we have. Oh, at Security Mutual, our tagline is the company that cares. They asked me, Marty, what would you suggest as the what would you suggest as the the motto for the company? I said, we sell dividend whole life insurance, the best financial product that's ever been created. It didn't go. So
Maybe
we are the company that cares.
a little long, but I think it still hits.
It's a little long. Yeah, I understand, but I'm a wordsmith, so I love using words here. So what we call what we call policies, the banking type policies, we call the capitalized whole life because it's a we think it's a better way to describe it there. Plus, we don't want to antagonize the banks there because the banks are big and we life insurance is a little smaller than them. So we call it capitalized whole life because you need to capitalize your whole life policy in order for you to become your own banker. So we call this what I'm going to talk about now is the combo rider. There's different types of paid up additions riders you can that people can put on their policies. So the real question is, well, how much premium flexibility do you want? Right? How much premium do you want to pay? And when do you want to pay it? Right? So those were the questions that we would run into. And so that's why we developed what we call this combo rider or a combination rider, because it's a combination of term insurance and paid up additions rider. And we say that it solves large premium and premium flexibility problems. Now, why is that? Well, think about this. Years and years ago, and I mean 40 and 50 years ago, you would buy whole life because you had a steady income. You would want to do it. So business owners, it was tough to do because guess what happens? You might have uneven cash flow in your business, or you would have what we call accounts payable. But lots of times, if you're a business, you have accounts not payable or accounts unreceivable, right? So that's the kind of the way it works there. So that would louse up if you had a premium, an all base premium of a whole life insurance policy that you had to pay. So what we wanted to do is make sure that it had more flexibility in terms of how much and when you pay. So that's why we created the combo rider. Nelson Nash would always say, hey, listen, the more you live, the more deals you get involved with, you're going to have unexpected windfalls. Where are you going to put that money once you have that money come in? Then you're going to have expected windfalls, meaning at some point in time, there's going to be a sale of an asset or there's going to be an inheritance. You just don't know. It's expected. You just don't know when. What do you need to have? Where are you going to put the money once you receive it? Well, if we think that dividend paying whole life insurance is the best money storage system ever created, we need to open up, give ourselves the opportunity to have life insurance policies in place so that they can accept these windfalls or these payments or this cash flow when it comes in. So that's why we created the combo rider. So it's as simple as creating a more flexible way to pay premium. So normally when you see something like this, you would put together, let's say a person would want to pay $20,000 in premium. The base premium would be like 8,000. The paid up additions rider would be 12,000. We call that a 40-60 split where I come from. And then if you look at the way that it's designed, well, you could pay that 20,000 for a long period of time. The death benefit would increase because of the additional paid up insurance would create more death benefits. So this is a very exciting and interesting way to pay this. Notice over here with the illustrations that I have in this particular example, after 10 years, the guaranteed cash value is what? Oh, it's 200,000. Every dollar you put in is guaranteed to be there, right? On the non-guaranteed side of the right side of the ledger, that's the non-guaranteed, you'd have a little bit more. The product I was using here for Security Mutual is the 121. We put a lot of emphasis. We don't want to pay. We put we say that we don't pay as much dividends on this because it's all in the guarantees, right? If you pay more guarantees, it's less dividend dependent. We kind of like that, and we use this type of policy lots of times when we're doing banking sorts of things. After 20 years, on a non-guaranteed basis, we put in 400,000. We're sitting on 573,000. The death benefit went from 500,000 to 1.9 million, almost 1.3 million. So it's pretty good. Our normal enhanced PUA offers, we allow, instead of putting in 20,000, we can put in 23,000 into the policy. An additional 25% can go into the PUA rider. 25% of 12,000 is 3,000. So that's where that additional premium comes up. And guess what? More cash value shows up then, right? That's how it works. Every dollar you put in normally shows back up in your cash value. But there's another way, the combo rider policy design. And Shawn, I'm going to say this, when the combo rider first came out many years ago, I called it Marty Smith's crazy good combo rider. And it is crazy good because when I show you how flexible it is, you're just gonna go crazy. So we can set it up, the combo rider, to look exactly like almost the premium paying period of what using our enhanced paid up edition rider is, right? But we have to increase the death benefit in order to do that. So we could pay $20,000 at least for 20 years. So instead of having a $500,000 death benefit, we're already at 1.1.
Okay.
So the numbers are going to be looking like that. The way the combo rider works simply is if I go back here, there's a $600,000 combo rider term death benefit. Every time you pay a PUA premium, the third column from the right is the PUA death benefit. So it buys down the 600,000 until all of it's completely, if you look in year 21, the PUA death benefit on a guaranteed basis has been totally converted into 600,000. All right. That's how that works. And then the term death benefit gets paid for what's remaining until it vanishes there. All right. On a non-guaranteed basis, oh, guess what? It works the same way, except now we have more dividends working to help move it along. So think about this. Can the combo rider get better than this? Oh yeah, much better, right? Because we have the additional death benefit, the 1.13, that creates a MEC premium. The maximum, the MP that I'm showing over here is 47,000.
Okay.
So now, instead of just putting in 20,000, I can put in really 47,000. And if I do that with a combo rider, I can put in 47,000 for 4 years. It's buying down the term death benefit. Notice in year 5 it goes down to 0, but I can't even put 47 in because all of the 600,000 based on the client's age and underwriting class is already been transformed into permanent PUA death benefit. So it allows me to get money faster into the policy. And what's the advantage of getting more money into the policy faster, Shawn?
Longer time for it to compound.
It's working harder for you.
Yep.
I'm a simple guy.
Easy.
That's why you want to put as much money you can in up front, because it works harder for you. It's compounding uninterrupted right from the beginning, right? That's the guarantee. That's the non-guaranteed. That's the way it works. You're always allowed to pay the base premium on this type of contract there. So you choose your base premium that you'd want to continue to pay, or ultimately you could stop paying at some point in time too, right? But the combo rider allows even a lot more premium. How would you like to pay 10 times more in terms of
to pay 10 times more?
10 times more than the base premium?
Yep.
Oh, guess what? All you have to do is increase the combo rider. So instead of 600,000, I make it 1.6 million, and now I can put in up to the new MEC limit of 88,000. How does that look? Well, again, now I'm putting more money into the policy. Holy mackerel. On a guaranteed basis, I put in 440,000. I'm at 420 on a guaranteed basis. On a non-guaranteed basis, I'm just a few bucks under. And after 5 years, every dollar I put in there is going to be there, right? The death benefit's higher. The combo rider is being transformed faster. That's how this works. Using the same base premium. What if the client wanted to pay more? How about 20 times more?
All right, Martin, 20 times.
How about 30 times more?
A little crazy here.
That's right. You can do it. I'm not even going to show it to you because It's just too much, right? This is great stuff. That's the reason. That's getting large premiums into the policy as fast as you want. And again, the base premium can be whatever you design it to be, right? Doesn't have to be low. It could be high because you want to continue to pay as much premium into the contract as possible because this is your money storage system. Oh yeah. That's why I want to keep paying the premium. So now flexibility. All right. So this is what I showed you before, right? This is how we started with a $1.1 million death benefit and paying the 20,000 all the same all along. But guess what you can do with the combo rider? You have premium flexibility. So look at the contract premium,
Yeah, over here.
Shawn.
Yep.
So I put in the minimum premium to maintain the combo rider in year one, 12,150. But then in year two, 20, year 30, year three, 30, year four, 40, year five, 50, year six, 60. Year seven, I drop back down. The point I'm trying to make here is you have this kind of crazy flexibility. You could pay what you want. You can do whatever you can imagine. What is it becoming your own banker about? As Nelson would say, it's an exercise in imagination, logic, reason, and prophecy. You prophesize. You tell me how much money you want to put into the combo rider, and we can actually mimic it. We can illustrate it to show you what it would look like. This is how flexible it is, right? And then, of course, what I always like to do over here is, oh, guess what? Guess what you can do with I use the 45-year-old. So it's age 65. What is my cash surrender value in year 20, Shawn?
Let's see, 832,000.
832,000. So if I just say, hey, roughly using 5% of 832 is 40,000. So I'm going to take out 40,000 for what? The next 30 years? 40 times 30 is how much?
Or you going
1.2 million.
I was gonna say 1.2 million, 4 times 3.
So I took out $400,000 more than what was in there as cash value, and I still have a death benefit. So this is almost like a total tax-free transaction if I were to die 50 years from now, whatever, of $2 million tax-free for my family. Why wouldn't you do this? Why wouldn't you do this? So here to show you even more crazy combo riders kind of thing here is like I put in the minimum to start the policy, 12,150. And in year two, Shawn, can you do this with other contracts that you've worked with? You can drop in 101,000
I don't think so.
and then go back to the base premium of 10. And then in year six, drop in 197,000 and then pay the base premium again. And then in year 10, pay 68,000 because that's all you're going to be allowed to do to pay down the rest of the combo rider term death benefit. You've transformed all that money into permanent PUA death benefit with never having to pay a penny again for that $1 million of death benefit. Wow. But you know what? Guess what? The person wanted to put in more money. So even though I paid in these things and only paid the minimum certain times, and I have to pay 10,000 through, my total surrender value in year 20 is what?
865,000.
Well, that's because of the way I've funded it, right? I could do it step by step. I could use the same premium, but guess what? With a combo rider, I don't have to. I can put in what I want, what we call the cumulative MEC calculation there. You as a client don't really have to understand that, but a cumulative MEC calculation is like, what? It allows you year after year. What you don't put in the first year, you can put in the second year. What you don't put in the first and second year, you can put in the third year. It's amazing. So here again, I'm still taking out that 40,000 for the next 30 years. Oh, so this is what I have for people, let's say business owners, for executives who receive bonuses. So I start off here with a simple policy of putting in $37,000 a year for 5 years. And then with the combo rider, because of the death benefit that I have, this big death benefit, well, I need a place to put money. Well, normally what happens in life when you get more successful, Shawn, when you get more successful, what happens in terms of money?
You start making more of it.
You make more money. And when you make more money, where are you going to put it? Well, you need a place to put it. So that's why we set up this combo rider with a $3 million death benefit. because we know in the future we have faith, we have confidence, we have hope that this is the way it's going to work. And what happens over here? So instead of 37,000 from year 6 to 10, I put in 62,000, almost 63. Now I'm even more successful 10 years from now. And between years 11 and 15, I put in 112,000. What? And then in year 16 and 17, I put in 212,000 until I use up all the combo rider term death benefit. How could I have continued to put in more than 212? How can I could how could I have changed this in order to put in more premium? The same 212?
More death benefit on there.
More death benefit. It's as simple as that. It's only arithmetic. That's all we're dealing with here. It's not some fancy calculus. It's not some advanced mathematics. This is just pure, simple arithmetic and understanding how things work. When you understand how things work, guess what? You're going to be in control of your life. This is why you want to become your own banker. This is why you want to master everything that's out there. You want to see what's there, what you can use, what you imagine happening in the future, what you prophesize to happen in the future. Nelson would be so excited to be able to see, like, this is what you could actually do. And then guess what? If you don't have the combo writer, guess what you have? You have more banks. You just keep opening up more policies,
Yep.
right? That's the other solution. All right. So now, oh, guess what? What was my cash value at the end of year 20 after I paid that down? Shawn, what's the total surrender value in year 20?
On this one, it's 1.99 million.
1.99 million. So what's roughly 5%? Well, we'll take 100,000. So we'll just take 100,000 out. We'll take 100,000 out for 25 years. That's 2.5 million. That's 500, almost five. That's 500,000 more than what we started with, and we still have the death benefit. Wow. It works crazy like this. Hey, what if you're an older person? A little younger than me, but an older person there. Let's say you're in your early 60s, right?
Okay.
Would the combo rider work for them? Shawn, imagine this. This was my dream. My dream, if only it would have come true, but I was aged out of this at the time because we have there's age limitations on what the combo rider is.
Of course.
So let's say a person like a person such as myself was sitting on a $800,000 IRA. The $800,000, when I take money of that out of that IRA, is that taxable or not taxable?
That will be taxable.
It's 100% taxable. Oh, I hate that. Why did I do this? Why don't I put my money in something like that?
Bad coach.
But guess what? Using life insurance, you can transform those 100% taxable dollars into 100% tax free. Obviously, you're going to have to pay taxes when it comes out. So what I did over here is to show that I'm going to start my combo rider. And in the first year, I'm going to have a contract premium of 117,000. Then I'm just going to pay the base premium the next year because I don't want to have this big tax problem there, right? So then in the next year, I want to take out more. So I'm going to take out 213. But look at all the cash value I'm sitting on. Where can I pay taxes from? Oh, guess what? I could pay it right out of the policy if I wanted.
Yep.
I pay the base premium again because I don't want a big tax burden. Then I put 121. Then I pay 21. Then I pay 121. Then I pay 21. And then I finally finish it up, rolling over all of that money from that IRA into a dividend paying whole life insurance policy. What's my cash value in year 10?
Year 10, we're talking about 1.27 million.
My 110, let me see. In the 10th year, total surrender value would be 942,000.
Oh, that was PUA death benefit.
Sorry. That's right. My total death benefit, oh, guess what? I only had 800,000. But now if I were to die, I gave my family an additional, well, I gave them all a $1.7 million tax-free death benefit as opposed to 800,000, 100% taxable.
Yeah.
Oh, so guess what I'm going to do? Oh, well, really, I had the IRA for retirement, right?
Yep.
So again, roughly 5% of 942,000. I'm just going to take 50,000, right, for the next 20 years. So I'm going to take $1 million out now. But how am I taking it out?
Tax-free.
Tax-free. And I still have a death benefit. Why wouldn't everybody be doing this? Why are people putting money into these other vehicles that have all these limitations, rules and regulations and government regulations just limiting you to what you can do and what you can receive ultimately in the end? You want to become your own banker. You want to own this life insurance. You want to have all this stuff to work for you, right?
Mm.
So guess what? If you had a minimum combo rider premium, that's what I was showing you before. You'd have the base premium, but let's say the cash wasn't there to start it. Well, you just put in the minimum combo rider premium and you pay for it. And it looks like that. If you don't pay any more premium into it, the combo rider term death benefit will drop off, right? But you
Mhm.
have the base policy where you could pay the 8,000 for, right? That's how that would work,
Okay.
right? But guess what? My MEC premium is 47,000, right? So let's say in the first year I put in that same opening premium, the 900, the 9,290, but then because it's a cumulative MEC calculation, 47 times 2 is 94,000. Guess what happens? Like whatever I didn't put in year one, what can I do? Put
Drop
it
it in
in
here too.
year two. And that's where the $84,000 comes in, right? That's how powerful the combo rider allows you to operate, right? That's how that works. So, what about the maximum premium? How could it play out? Well, you put in the minimum, then you put in the maximum in year two, and then you just finish this all out. Your cash values are going to be pretty much the same all the way through because of all the monies that you've dumped into it. But the combo rider is flexibility. So you put in the maximum premium year one, the minimum year three, and then year five, drop in 163,000, pay it all down, all the combo rider transformed into PUA death benefit. Or you put in a little bit more in year one, wait until year 10. And in this instance, in this specific example, I drop in 224,000 to buy down the term death benefit of 568,000 in year nine. All of it's transformed. Pretty
That's a
cool.
lot of flexibility, man.
That is flexibility.
That is crazy.
So again, why am I showing you this? Why am I trying to have people understand this? I'm trying to help you understand that there are features from whole life that offer you this flexibility that didn't used to exist before, right? If you're a business owner, this is why you want to take advantage of this. If you have additional monies coming in, if you're an executive with bonuses, you want a place to drop this money. If you're a salesperson and you have fluctuating income, things like that, you can have whole life. You can do this. The wonderful thing is, Shawn, do you have to wait for the policy anniversary to drop in money on the combo rider?
You sure don't.
You don't. You if that money comes into your bank account tomorrow, what do you do?
I'm
Oh, well,
sending it over to the policy.
you call up the policy owner service area of Security Mutual and you say, "Hey, listen, I got like a $50,000. Oh, I got $100,000. I got $150,000. Could you take that out of my bank account and put it in my policy into my combo rider?" Oh yeah, let me just check, make sure you have enough room for it. Oh yeah, you do. All right, we'll take it. Send us an email. We'll we'll, we'll take care of it.
And
It's as
Marty,
simple as that.
this is also such a great way. Something that we talk about all the time is with, when you're doing infinite banking and maybe policies don't require term, people often have that lower death benefit that they're starting with. And like you
Right,
mentioned at the beginning, the most important thing is your family, protecting your family. So a great thing about this is that it's allowing you to up that
right,
protection that you
right.
have, making sure
No,
that
it's great that you pointed this out. Your family is your most important business. If you're not treating your family like your business, you're going to make bad decisions. You are. You're going to make. It's going to be harder to make decisions. But again, from my experience, which I've had a little of, it's like whenever I deal with business owners, you're if you're a business owner, you're able to make decisions, right? You're able to cut through the nonsense there. When you're with your family, things could get cluttered in your mind, or there's going to be things at work there. But from the real perspective, if you treat your family just like it was a business, you're going to be able to make these decisions. You're going to be able to make tough ones. You're going to be able to make easy ones. You're going to be able to make sure that first and foremost, your family's protected with that significant death benefit that's needed just in case you're not going to be around anymore, right? If you hang on to it long enough, It becomes a deferred asset. And then ultimately, what do you want to use your policies for if you become your own banker? Well, you want to use it as a current asset. And that's really the story that this is all about. All right.
Love
So,
it.
so, here's my sales pitch. What other policy or rider can do what the combo rider can? So I did this years ago. Guess what? There is none. There might be some now because the wonderful thing about the life insurance industry and all industries is when something good is out there, it sure needs to be copied. So that's the story. But for the most part, the combo rider, it still stands alone as far as I can see. All right. So that's that story. Now, there is a third element here, Shawn, if you want me to go into it a little bit, but that's up to you.
Go right ahead. It's gonna
All
be
right.
it's gonna be
Okay.
a long listen,
All
guys.
right. Hold on. Wait a second. That tagline, the company that cares, that's wrong. We sell dividend paying whole life insurance, the best financial product ever created. Oh, no, sorry. That wasn't chosen. Okay. So here we go. I call this using creativity and liquidity with capitalized whole life.
Okay.
And see, what is life insurance? Never discount how important that death benefit is.
Yep.
Me being an older person, much older than you, Shawn, it comes in handy. That's what it's all about. And that's the reason why you can have it, right? It is the death benefit. It's a deferred asset if you don't die and you live long enough. And then ultimately it becomes a current asset. And that's what we love to say at Security Mutual, because Security Mutual, we are one of the top companies always when it comes to this. We believe in this concept. We promote it. The people who work with us, the most successful people who work with us, most of them do infinite banking, becoming your own banker. That's how that works. All right. So the little story is there. I did this years ago for my son when he was 30 years old. I said, son, I said, do you believe Social Security is going to be around 40 years from now?
Nope.
No. So if Social Security is going to be around, do you think taxes are going to go up or down or stay the same? I think at the time of this, when we spoke about this, I think what's the national debt now?
Oh my gosh. I don't know.
38,
38
38 trillion. I think it was 18 trillion at the time. So think about that.
things are getting better.
Well, I guess from somebody's perspective,
Yeah.
yeah, yeah,
Whoever's spending that 20 trillion, right?
that's it. 20 trillion for, oh yeah, yeah. The government starts spending money it doesn't have. That's going to ruin everything there. So what I did is I set up a policy for my son, right? And so I had a base premium of just around 5,000. I added a 10-year level term rider, right? And then I had a $8,000 paid up additions rider. This is our normal enhanced paid up additions rider.
Okay.
So we're going to start off with $13,070. The $70 you see is going towards the term rider. Okay.
Gotcha.
All right. So now we're going to put money into the policy. So this is a later version of the policy. And so, after 10 years, we put in 130,000 on a non-guaranteed basis. On a guaranteed basis, we're at 126, but on a non-guaranteed basis, Shawn, what is the total surrender value in year 10?
133,000.
That's it. We started with a $600,000 death benefit. And then what are we 10 years later? Already a million.
63,000.
Son, you're protecting your family. This is wonderful. All right. You're going to continue to pay this because if Social Security is not going to be around and you believe taxes are going to go up at some point, when reality hits, whatever, to pay some of this debt, you need to create your own, as I would say in the old days, a private pension plan, or you would need to do something to replace Social Security. This is what you would do, right? You would use dividend paying cash value whole life insurance, which it was one of its original purposes years ago when there weren't pension plans. Before pension plans, people stored money where? Oh, they stored it inside a dividend paying whole life insurance policy because of all the advantages of cash value growth and able to access money without having to pay taxes. So your death benefits could continue to grow here. So what we're going to do over here at age 70, 40 years from now, what's going to be the total surrender value that you have, Shawn, there in year
1.273 million.
1.273 million, and your death benefit has gone from 600,000 almost 4 times. It's greater. It's 2.25 million. All right. So, so what are we going to do originally? Oh, guess what? We did this to replace Social Security. So if you're sitting on 1.273 million, 5% of that roughly is 60,000. So you're going to take 60,000 a year,
And again, just some simple math, guys. 60,000 a year is
5,000 a month.
$10,000 a month.
So you're paying a little over, you're paying like less than $1,100 for your premium for this time, right? But
Hmm.
now you're taking $5,000 a month tax free,
Tax
almost
free.
5 times as much. Wow. And so you're going to do that for the next 30 years, right? That's pretty cool, right? 30 times 60 is what? 30 times 60,000 is how much, Shawn?
Is that 1.8?
Oh, just 1.8 million. Yeah, we only had 1.27, but now we're taking 1.8 million out and we still have a death benefit.
Hmm.
Wow, pretty cool.
That
But
is
guess what? Son, the most important thing about life insurance is that it's a current asset. So this sort of takes me back to where it was. So what are you going to start doing? How much cash value do you have in year five? At the end of year five, your net cash surrender value?
52,000.
52,000. So guess what? You're going to, mom and I gave you a car, right? For what purpose? For so you and your spouse and my grandson, whatever, could hey, drive around. Now you're going to trade it in. So with that trade in, whatever they're going to give you, you're going to add another 25,000 to get the best car that you want for yourself at that point in time, right? So
Hmm.
you're going to so when you call up the life insurance company to get a loan, what are they going to ask you?
Where do you want us to send it?
Wait, have you heard me do this before? This is unfair, Shawn.
That's what
Yeah.
they asked me.
They're not going to ask you what you're going to use it for. They're going to say, where do you want to send it? Oh, should we put it in the same bank account that you've been using? Oh, yeah. Oh, that's good. So they're going to drop in 25,000 within 48 hours of that or sooner, right? Into your into your own bank account so you can drive off the lot with the car, right?
Hmm.
So notice over here, what is my loan repayment in year one? I mean, in year six?
Big fat zero.
Zero, because who's in control?
I'm in control.
You're in control. This is why you want to be your own banker. This is why we do this stuff. What is the net cash outlay in year six?
Let's see here. Net cash outlay in year six is the
Minus
yep, the negative 11,900.
11,000 minus 11,930. Well, how do we get that? Oh, well, when there's a negative sign there, that means that we gave you 25,000, you gave us 13,070, and the difference between minus 25 and 1370, oh, that's the 11,930, right?
Got it.
Great. And so then what we're going to do is we're going to pay off the loan in the next 4 years, right? Because you're going to trade in and you're going to buy cars every 5 years. That's it. So notice that the total loan in year 10 is going to be zero, correct?
Yep.
Right? What's the cash value in year 10? The net cash surrender value?
133.
133. And the death benefit is 1.063.
Yep.
Well, if we go back to what it was without the loan, oh, guess what? It's the same, right?
133. 1.063.
Right? So that's how that works, right? So now Nelson has an example in his book, and I know Hannah loves using this example of paying monies and then taking loans and then subtracting, adding, doing all sorts of crazy stuff, which is good to show what the gain in that contract is. Oh, kind of like what I was doing, showing the gap, right? But now we have ongoing premiums. So we're going to pay 13,070. We're going to continue to pay the premium, right? But
Hmm.
we're going to repay the loan starting in year seven. So that's 7,300. So if you look under net cash surrender value, it's the contract premium plus the loan repayment, just like you would pay to the Toyota dealership down the road. So you gave the life insurance company 20,370. You see that?
Yep.
Net cash surrender value. And then finally in year 10 to pay this all off, you don't have to pay 730. You can 7,300. You can pay 6,432. And so that's where that 19,000 comes in. So if you add up all the net cash outlay for those 5 years alone, what is that going to add up to? Well, that's a little bit tougher, right? That's going to be like 68,800, 68,682,
Okay.
right? So the thing is, what was the increase in cash value from year six to year 10?
Oh, like 90,
92,000.
92,000.
92,296. So if you subtract your net cash outlay, which is just your premium plus your loan repayments of 68,000, 296,000 minus 68,682 equals you gained $23,614. Remember, I was showing you 220,000. Remember the locked off zero?
Yep,
That's it.
there it
So
is.
this is it. So by you doing this, your cash value grew, even though you have this, even though you took a loan and repaid it, it grew $23,000. Wow. Wow. Pretty cool.
Thank you.
I'm not going to do the math because we're running out of time over here, but the same things, if you did that same thing, added up the net cash surrender, the net cash outlay, and then did the subtracted 125 from 230 from two, whatchamacallit, 235,000, the year 15 net cash surrender value, it's going to be over 40,000, right? It
Mhm.
just continues to grow and grow. Why do you want to do this? Because you're going to take loans. Over here, I show you taking $50,000 loans. You can take 800, yeah, $100,000 loans, whatever you want, because you have all this cash value. But the point about this was what I was trying to show, Shawn, in year 40, what is the net cash
One
surrender value?
1.273 million.
1.273 with the same $2.25 million death benefit. And what are we going to do at that point in time? Well, guess what?
Money out for Social Security because we
We're
don't.
gonna, we've done it. We've bought all these cars. We've, we've, we've supplied everything that we need in terms of buying cars just with this one policy. And we have plenty of money left over to do all sorts of crazy things with it. Pay for college education, pay for any private financing, pay for business equipment, pay for investments, do whatever we want. But when we repay all the loans and there's no loans outstanding and the dividends have stayed the same, it's going to look just like this. It's going to produce the value, the cash value that we need to take the 60,000 for 30 years tax free that we want.
Mm.
This is how powerful these contracts are. It just blows my mind every time I think of it there. So, so let me tell you, that's it. I'm done.
That was fantastic, man.
That's it.
I hope you guys got a lot of value from this. I know I did. Again, I've seen Marty do this before, and I was like, yeah, you definitely got to come on and share this with the people because often I like the numbers. I like seeing the illustrations. I like seeing the loans being taken, the policy, cars being bought, pension income being utilized, and just showing you in depth, in detail, how the policy actually functions. And the fact, again, that the whole idea is, hey, I'm not going back to a zero line when I pay these things off. I am on this constant curve upwards, this hockey stick curve trend upwards. And at the end of the day, I'm checking off all of these boxes. I'm checking off the access to money box. I'm checking off the protection of my asset box. I'm checking off the protection of my family box. I'm checking off the growing my money tax free box. All of these different boxes that we look for in all of these different places, you just happen to find in this one vehicle that, again, with this combo rider has unlimited flexibility, it seems like. So, hope this had a lot of value for you guys. Marty, I can't thank you enough for coming on and doing this, man. It was fantastic.
Shawn, thanks so much. I really appreciate you giving me this time to go over this stuff. I guess what I would want to leave everybody with this idea is that if you've been struggling with money, if you've been struggling to understand how it really works, or if you've been introduced to the concept of, from Nelson Nash of becoming your own banker, right? If you have that and that you somehow don't get it, it could be as simple as what I showed you in the beginning, that aha moment: loans, saving, or where do you get money from? Is there a better way to access money that's going to build wealth for you as opposed to having to see all the numbers and prove it to yourself? And in reality, that's what's all I needed to see. So whenever I run into people who are accountants, Shawn, or engineers, because they love seeing numbers and stuff like that, Well, guess what? We have the numbers to show it. We have the simple arithmetic to make you confident and clear-minded about what this is all about. You have clarity in terms of seeing this number and being able to understand what it really means in relationship to what the concept is all about. So
Uh,
thank you so much again. I can't tell you how much I was looking forward to doing this. I'm
well,
sorry I had the flu a few weeks ago. I just
me too.
every time I took a breath, I was coughing.
I'm still coughing now. It hasn't completely gone
Well,
away.
that must be a Chicago cough. That's all.
Yeah,
That's it. All right.
Marty, I greatly appreciate it. And again, uh, thank you for your time and looking forward to doing another one as soon as you put another one of these fantastic, maybe updated presentations together. I'd love for you to come on and
Sure.
share.
That'd be great. I'd love to do it there. So
All right. Thanks, Marty.
thanks so much.
All right, you guys, that's a wrap. Woof, man, that was fantastic information. That is exactly what I love about doing this. Marty has been doing it for a long time. He is a veteran in the space and knows this product and this concept like the back of his hand. So, like he said, if you haven't already, grab yourself a copy of this book. There will be a link in the description below. Get yourself a copy, read through it. If you got questions about the book itself or what Marty just shared in his overview, do yourself a favor, head on down to the description, book yourself a free call, and let's hop on the phone and chat. I'm here to answer whatever questions you have, help you get educated, because remember, at the end of the day, this information is caught. It's not taught. I can tell you everything that you're going to need to know, but we got to figure out what's going to help make it click in your mind for you. At the end of the day, you guys, the information is free, but the knowledge is priceless. I appreciate you tuning in. Hit him with that outro music. I'll catch you on the next one. Peace.
Invest in your future, there's no time like today. Tune in, rise up, elevate your game. Financial freedom is possible, and it's yours to claim. Cash flow is key, best believe we'll teach you the way. Invest in your future, there's no time like today. Tune in, rise up, elevate your game. Financial freedom is possible, and it's yours to claim. Oh, oh. Welcome to the Cash Flow Chronicles, where we're redefining wealth and overcoming obstacles. Infinite banking, yeah, we control our cash. We put our money to work, so we know it's gonna last. Cash flow is key, best believe we'll teach you the way. Invest in your future, there's no time like today. Tune in, rise up, elevate your game. Financial freedom is possible, and it's yours to claim.